Check back Sunday morning. I'm going to be talking about some of my signals. Got mixed signals. Some signals are bearish, some signals are bullish. Some signals turn bearish and are turning back to bullish, like here with the swing trend line. Hard to see. It went from green to red to green. Talking about some of these signals, I'll show you what I'm going to be watching for as we go into next week. Oscillators going negative, and confirmation and a follow through. Talking about some of these charts. I'll even be talking about the weekly charts, real important, the weekly signals that we got. Dow just had the biggest drop that it's had all year, 3%. It recovered, still down sharply, and the worst week of the year so far. Talking about the distribution, I know distribution's going on, but we're bouncing at critical mass. There's still the possibility we're in the topping process, and I'll be talking about these signals. Reversal of conditions, signals. Again, some signals are bearish, some signals are bullish, signals are going back and forth. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you follow the link below, it'll take you to a secured site. You can donate any amount you want. Make it a recurring donation. If you do that, I thank you so much. I need to hear from you. I need your help in order to make it work. If you like the indicators, let me know that. Supporting what we're trying to do here. And I thank you for your consideration for that. Also, check back Sunday morning. 7 a.m. Eastern Time, I will be posting another video. Well, we got the jobs report, came in very strong, but I'm sure it'll be revised downward later as they usually are. More about that in a minute. We got crude oil continuing to rise. It was a Thursday, it was up 4.11% for the week, and it closed out 4.50%. 4.5% for the week. Crude oil rising on tensions in the Middle East. We want to be paying attention to that. Sometimes geopolitical issues rattle the stock market. It did on Thursday. We had that sell-off. Oil began to surge. The stock market began to turn. I was down 3%. The NASDAQ and S&P, they were down 2% each. We rebounded on Friday. We've had this breakout with crude oil, so we want to be watching. Do we get an immediate back test, or do we continue to rise with crude oil and rise up towards this 94, 95 area, which is horizontal resistance from this high over here, from the highs over here, and over here we broke it and then tested it. And it was support back over here. So this 95 area is some key resistance. And do we, come up here and then kind of back test, or come up here, try to break through this area, or do we get an immediate back test? But we have broken out of the downward trend and of the channel here on crude oil as it's risen. As tensions heat up in the Middle East, and again, to see if that impacts the stock market going forward. Do tensions escalate, or do things calm down? Tensions rising, and there's concerns about a regional war. Again, the CIA warning that Iran is going to respond to the Israeli strike in Damascus that resulted in the deaths of high-ranking military officials, Iranian military officials. Tensions heating up. Again, sometimes these things rattle the stock market, other times they don't. You just never know. Something we should pay attention to. This is this conflict, according to the U.S., is likely going to take place over the weekend here. So maybe when you're listening to this, maybe it's already started. Maybe it hasn't. We'll see what happens, and then we'll see what happens with crude oil going into next week, and any kind of reaction out of the stock market. Again, CIA warned that Russia was going to invade Ukraine, and then when it happened, the market really pretty much ignored it. There was some volatility with Israel preparing to move into Gaza. It actually happened. Again, the market pretty much ignored it. So, you never know with these things. Geopolitical issues, sometimes they rattle the stock market, and sometimes they don't. It's just something we should be paying attention to, because even if the issue doesn't rattle the stock market, crude oil prices could, concerns of inflation going forward. So just something to pay attention to. The crude oil chart next week, breakout of the downward trend line, tensions in the Middle East. So just pay attention to this over the weekend, and then we'll see what the stock market and crude oil do going into next week. Something worth paying attention to and keeping on the radar screen here. Remember, crude oil is moving into its positive seasonality here now. Breakout of that downward trend. We have these Fed officials, not this last week, but the week before that, you had Waller and Fed Chair Powell telegraphing the message that, hey, no rush to cut rates. It was echoed this week. Some Fed officials are saying, hey, no rush to cut rates, but still, penciling in the 3 cuts. Others, like Fed Governor Bowman, hey, we may need to do the opposite. We may need to actually raise rates, hike, if inflation stays elevated. A Fed official earlier talking about rates higher for longer. Fed President Daly saying the same thing, no urgency to cut rates. I told you, with the comments Powell is making, it didn't show up into Fed Fund futures. Powell is essentially canceling the June rate cut. It's now happening with Fed Fund futures. I'll show you that in just a moment. Now, we had the jobs report come in very strong, but I'm sure it's going to be revised down later. That's what the Labor Department continues to do. Came in at 303,000. Employment rate dropped down to 3.8%. And if we just look at the economic calendar here, you could see it was expected to come in, the unemployment rate, at 3.8%. It did, but that's still lower than the 3.9% we previously had. Non-farm payrolls were expected to come in at 200,000, came in at 303,000, 50% more what it came in. Now, we did have the revision with the previous month, but it was a small revision of just 5,000. Sure, it'll probably be revised lower later again with another second revision. Nevertheless, still elevated. 270,000 was at 275, and we came in 50% higher at 303,000, opposed to the 200,000 that was consensus among economists. The sell-off, as I talked about in Thursday's update, we had the sell-off before this report came in, was a waterfall sell-off, really 4 hours of straight selling on the 15-minute chart with no rebound whatsoever. So we got a rebound. Again, as I said, here's update. You would think with a hot report, strong report, market would sell off. Weak report, the market would rally. Well, it rallied anyways because we did get a pretty sharp decline there on Thursday, tapping higher and then selling off nearly the last 4 hours of trading on Thursday. As I said in Thursday's update, again, we got the strong CPI report last time around, and the market rallied anyways. It didn't sell off, and I told you, may see it defy logic. It did. But with the strong jobs numbers here, coming in 50% more than the estimate, 303,000 higher than the previous month at 270. So we saw a strong, a couple months of reports. But let me just say this real fast. Again, we keep getting the Labor Department overestimating the numbers. Quietly revise them down later when nobody's looking. And again, this is only revised down by 5,000. That doesn't mean it won't get revised down by more than that later. But we're pretty much getting, bogus numbers out of the Labor Department. They're playing this game where they overestimate and then they lower later on when nobody's looking. A while back, I did a video and I went through past year, and I mean, the revisions are just insane. I mean, it is, at a point where they're either completely incompetent or they're purposely putting out misleading information, and I think it's probably the latter. Plus, again, whether you agree or disagree with the numbers, it's all we have to work with. Eventually, let me just say this, eventually we're going to start getting negative, and they can play games with the revisions, but at some point we're going to get negative numbers, and you can only revise so much. You can only manipulate the numbers so much. I mean, even if it's still being manipulated, at some point we're still going to see negative numbers going into recession. Just keep that in mind. Just remember, right before recession, even if they are, cooking the books or whatever, still positive at this point. Stock market tends to top, when the economy is strong, and it tends to bottom when the economy is weak. Keep that in mind. We got the strong jobs report. Remember, Powell, 2 times we've heard him speak, he was saying, hey, no rush to cut rates if we have a strong economy, we have a strong labor market, well, supposedly, if that changes soon, but it is misleading as well. I just want to say this, that the jobs that are being created are part-time jobs. Full-time jobs are on a decline. We've already seen the U6 begin to turn around, and we've bottomed out with the, 3.8 whatever it was, 3.3, 3.4, whatever it was, that low, and to see the unemployment rate tick back up. What's happening, usually you see a stock market topping process, and eventually when we start seeing the unemployment rate go higher, the steepening of the yield curve, it's when we begin to see the stock market begin to fall apart. Eventually you see the job losses, and the stock market will price all of this in and price in recession and so forth, and the coming banking crisis, which we are going to have. But nevertheless, I digress. We've got this 300,000, so 50% more than the estimate. Strong report after Powell saying, no rush to cut rates. Strong economy and inflation remaining above their target level. So again, I keep saying June cut is going to be canceled. We're now seeing that happen. Powell is canceling the cut based on his last two speeches. On futures is now beginning to price that in. The stock market will eventually price that in. I want to talk more about that in just a moment. But keep in mind, next week we have the CPI data there on Wednesday the 10th. And again, CPI the following day. The CPI is expected to come in 0.1% on a month-over-month with the headline, the core the same. Last time it was 0.4, and remember, we missed the last two estimates, last 2 months, so we'll be watching this one. But here's the thing. We've got the headline, year over year, it's expected to go to 3.5%, higher than the 3.2%. So it's going to come in higher, significantly higher on a year over year basis. And then we have the core, which is supposed to come in lower. It's supposed to come in at 3.7, and we have it at 3.8. And this is the core year over year number. So just keep that in mind. We do have other Fed speakers next week. Again, they continue to echo no rush to cut. Now, the Fed Fund futures had priced in 5 cuts, then it went to 6, then it went to 7. Eventually, it came back down from 7 to 6, back to 5. It was pricing in too many rate cuts. Fund futures eventually adjusted. It was hovering between 3 and 4 cuts. Now it's been holding steady at 3. The stock market never corrected and readjusted that. Still has too many rate cuts priced in, and while Fed Fund futures has moved back, we're now getting the cancellation of the June cut. As I've been warning you, what's going to happen. I told you that Powell has been saying he is signaling that the June cut is now off the table. The June cut is now canceled. Fed Fund futures after the jobs report is now beginning to price that in. The betting markets have eliminated the June cut for now, at least for now. And again, this could change, but for now, I'm warning you, which I do believe that that's going to be the case. I think I told you, if we get, so be in the latter part of the year here, the last half of the year, still may be fewer cuts than hoped for. And right now it's at 3, had been at 7. So again, just unrealistic expectations. If we're going to get 7 cuts out of the Fed, the economy has to be in complete shambles and falling apart. Again, in order for the Fed to, let me just say this, in order for the Fed to properly deal with inflation, we need a recession. That, we're going to have the soft landing and all that. They know we're going to have a recession. Powell has to say that. They come out and say, oh, yeah, we're going to have a recession and we're going to have a bear market and the economy is going to be horrible. I mean, he'd rattle markets and they run them out of town. But again, they always got to go with this. And all the experts on the financial channels, the same thing. They say the same thing every time before a recession, that we're not going to have one. We're going to have the soft landing, which is a complete fairy tale. Last three recessions, they've told us we're not going to have a recession, and we've had a recession. Actually, the last 4 go back into the early 90s, and every single time we've had a recession. Again, we are canceling out that June rate cut, at least for now, 50% probability now we're going to keep rates holding steady, and that the first cut now is being moved to July. Now, again, possible we get that in July. Still possible they reduce the cuts down to 2 or 1 and push it back still further into later in the year. Currently, we're slated for now, based on Fed Fund futures, 1 cut here. By the way, that's below 50% for that first cut for the probability, by the way. The other one, well, the June one was 50, hovering between 50 and 60%. Now that's been taken off the table, at least for now. So again, this changes every single day, but I just wanted to show you this after we get the jobs report that June cut is now gone. I'm telling you it would be. Now we have it being pushed back into July, and then another cut here in either September or November, and then another cut in December, and the stuff down here is for 2025. We still have three cuts being penciled in by Fed Fund futures. We'll see what this looks like after we get the CPI data next week. But again, warning you about this because we know that the inflation data has been sticky. Now the Fed is coming to that conclusion as well. So at the moment, the June cut off the table. The June cut, as I said this past week here, I think Powell's officially canceled that June cut. I'll be watching to see if this eventually becomes a catalyst for a reversal going forward if we end up seeing evidence that there might be fewer than 3 cuts. But keep in mind this data changes every single day, so it changes throughout the day. So, the June cut might be put back on the table and then go away again right after the jobs report here. So far, it's been canceled, but probabilities change every day and throughout the day. Just keep that in mind. We'll probably see it be put back on again and then take it off again in the near future. Thursday, before the jobs report was released, the market opened on Friday. We had on Thursday a gap higher. I told you about this bull flag pattern that had set up ahead of Thursday's gap. We talked about that and talked about this gap down over here earlier in the week. And I told you I thought we'd go up and fill that gap and maybe challenge the highs or get a lower high. We were watching to see which way it would play out. But we gapped higher here, filled that gap, and then we formed negative diversions in the 5-minute time frame, and we began to get that waterfall sell-off. And we sold off, and you can see it on the 15-minute chart. We sold off for nearly 4 hours straight. No rebound whatsoever. I'll show you this on the 5-minute chart. We got this bullish diversions right here at this bottom here on the RSI. We began to rebound, saw the futures be positive, and the market attempted this rebound. And again, we went up to the 200 period, stalled out, got a divergence there, pulled back, and formed another little bull flag and broke out of that towards the end of the session and closed there right just under the 50 here in the 5-minute time frame and under our 200 period. So here's the deal. If we can get back above the 200, if the 50 could get back above the 200, then you could get some traction back up. If you get rejection in this area, it could be back testing that trend line. 2 trend lines, the lower boundary of the rising wedge and the lower trend line channel from the recent minor lows. I'll show you that in a moment in the daily time frame. But here it is. We had that waterfall sell-off here after the gap, and it created a gap and trap, at least so far, unless we can get above our 200 period here in the 15-minute time frame to challenge that high. After coming back, filling the gap over here, didn't draw that straight. After filling the gap right there, again, it was a gap and trap. So we're on the rebound now. We have the bull flag. Did we try to get above the 200 on the 5-minute chart, the 200 here on the 15-minute chart? So that's a price action here over the last couple of days. The waterfall sell-off broke this trend line right here. And we've had 2 trend lines break. Okay. On Tuesday, the break of the lower boundary of the rising wedge. And then here on Thursday, we saw the break of this trend line. And again, this is just from the last few minor lows here that we have this channel, kind of a channel in the more recent price action. And here, tried to bounce here, went back up, filled the gap, and then came down. And that really back tested the trend line of our rising wedge. Now we're back testing the break of this trend line. We had dropped below our 20 period moving average. You see that little blue line? We dropped below it, and now we're back above it. But we're stalling again at that 10 period. The red line there is the 10 period and back testing this trend line. So if we can clear this level, because we have a break, but there's no confirmation and there's no follow through. So if we can clear the trend line, you can get a bigger rebound. The Dow has still not cleared or filled its gap. While we got the gap fill on NASDAQ and S&P, we did not get it on the Dow. The question now becomes, do we have a back test here and we go and we resume the decline and get the bearish engulfing candlestick that we had on Thursday? We get a confirmation and a follow through. This is what happened in July, where you got a bearish engulfing and you got a lower high, you rebounded back up, and then you confirmed it a few days later. Could we do that? Sure. We could just easily get back up here because we are seeing some strength on the 60-minute charts, the Dow for the S&P. If we can clear the trend line come Monday or Tuesday, then again, you could still buy more time. And as I've said, Dow hasn't filled its gap. It still may do it. If we get back above this trend line, we still may challenge the high over here. Remember, S&P just moved 3 points above this previous peak over here where we hit the trend line. The NASDAQ and the Dow made lower highs. It's going to come down to, do we come down and confirm here and resume the decline, or do we get above this trend line right here and fail to confirm the break of that trend line here on the daily chart? And again, there's still the possibility, still trying to climb to this trend line, which we continue to reach over and over. My trend line moved on me here. Hang on. Sometimes I hit save on this program and these trend lines move. I love the charts, but the trend lines move sometimes. They have a mind of their own. But this is a trend line to be watching. And then again, the upper boundary of the channel. I'll show you that in just a moment. Keeping this trend line in mind right here, that we broke it and we're trying to now back test it. And if that's successful, then we need to come down and start moving lower. We also have broken down from the rising wedge and have already back tested that. And you can see that best right here up close. Again, we have this trend line right here, and I've taken that from the low here and right here, and we broke down from that on Tuesday, hit that other trend line I just showed you and tried to rebound. But then we kind of back tested this over through this trend line just ever so slightly here, just over through it, filled the gap, and then began to turn down. So we now have a break and a back test, and bearish engulfing can get confirmation and a follow through, then you might start a trend reversal. Signals have turned bearish, others are not there yet. So again, now it's the waiting game. Do we go back and we try to get back above this trend line and the other one I showed you from the more recent minor lows there? And if so, do the Dow fill its gap? And what happens here? Do these highs hold on the S&P 500? And again, we busted the trend line a couple of times and we keep getting back above it. Here you busted it. Here you busted it. And again, we failed to get confirmation when we busted it. Here we broke it. We did get confirmation here, but not with the other trend line. Here we broke it, and now we have confirmation. Now you need a follow through here. You need confirmation and a follow through with the other trend line I showed you from these more recent lows right here. Now, if we try to form a divergence and come back up to this trend line or the trend line of the channel, going back further in just a second, again, still may try to move up to one of those trend lines and still may end up forming a divergence should we take out these levels. So again, we'll be watching that. Again, turn down, we need to see convincing evidence of that. And right now you've kind of got some mixed signals. I'm going to show you these trend lines, but it's not just that trend line that I'm watching. If we are to rally, and again, it may be that we're just back testing this trend line. Here's the rising wedge going into this really nice looking channel here on the S&P. And if we get a bigger rally, you've got two trend lines to be watching. You've got the upper boundary here that I've just shown you up close, and then you got the trend line here, which is a parallel boundary to this lower boundary right here, which again would take us up to levels back, above the broken trend line, but maybe not back up to that upper boundary. So again, I'll be watching these two trend lines right here. If we attempt to further upside, can the Dow fill its gap? The S&P already did, but the Dow did not. It doesn't have to, but it could. Well, we have these divergences that have formed, and again, they don't play out immediately. multiple point divergences produce reversals, but because they don't play out immediately, and again, my signals have been consistently bullish, showing signs of some weakness with some of the signals turning bearish, all of them a mixed bag. Because the signals don't play out immediately, people go, oh, they're not going to play out. And again, the signals have been bullish as these divergences have formed, as I've been pointing out. The trend lines I'm watching here in the daily time frame. The S&P 500 was up 1.11% on Friday. It rallied back up to that broken trend line from the more recent minor lows. Here on the 60-minute chart, again, we violated that 200 period moving average. Now we're attempting a rebound. With the jobs report, we've come right back up to the trending candle, or the trending cloud, and the momentum line, that little purple line right there. If we can clear these levels, then again, you can try to get a bigger rally, and if we do, then maybe the Dow fills its gap. S&P already did come up and fill the gap over here. The Dow did not. The Dow doesn't have to. It may do it at a later date. It may not do it at all. It is a possibility if we can get further upside. But as we're rebounding back up on Friday, we're seeing the momentum turn back up here. And again, we never did reach extremes here. So again, we still come up here and reach extremes going into the CPI data next week, and then roll over or even form a divergence extreme here. But we are trying to bounce off the 200. As I've talked about all week, you got to have two things. If we're going to see a sell-off, you got to take out this 200 period and remain below it, and then get the 50 dropping below it and price holding below both the 50 and the 200. Okay, consistently. And in a counter trend, you'll get above the 50, but you got to hold below that 200 consistently. The other thing is the 20 period moving average. You got to drop below the 20 period in the daily time frame and remain below it. So far, we've come down to these levels and we're rebounding. So the 200 period here on the 60-minute chart, and you're turning back up. So we'll see, do we try to rally ahead of the CPI and come back up further before getting more volatility? Do we go up and try to hit the trend lines I've been talking to you about, the trend line back over here or the one of the channel, and do we exceed this level or not and move towards 5,300? So far, this 5,365 area is holding as resistance. Here's something I'm showing you. If we see strength, and if the bull flag plays out on the intraday charts, the 5 and 15, then back above the 200 period on the 15-minute chart and the 5-minute chart, then maybe you go up and you challenge the high right here, or the high over here at the 5265 area. And if we do, then maybe the S&P tries to get above the 10 period and the trend line. Now, if we get rejection here, again, you need confirmation for the bearish engulfing candlestick and the breaking of this trend line. You need confirmation of that. We already have confirmation on the break of the lower boundary of the rising wedge, but we need a follow through. So we need both. You need confirmation and a follow through for this trend line. We're looking at two different trend lines. We get back above this level and we go back to challenge the highs. The bears' heads will explode. I get some technical damage. We start seeing some signals go down, and the bigs come in, drive it back up and say, oh, just kidding. And the bulls come in, buying the top, doubling down. There's nothing taking this market down. The market is designed to do as much damage to both the bulls and bears as possible, hitting this trend line and getting reactions off of it, but not a reversal. Or this peak right here, this reaction off of it, area of resistance is holding. We came up 3 points above that level and then turned back down. Possible reversal, but again, we need more confirmation with these trend lines, as I've said. Confirmation of follow through here, a follow through with the break of the other trend line. But the market is designed to do as much damage to both bulls and bears alike. And if we push on higher above the trend line, you're going to trigger all the stops, have the bears throw their hands up in frustration, triggering stops. That will create a short squeeze and produce a breakout, and then bulls will buy the breakout and say, here we go, and then the market will go, not. It has stopped out. If we move above this trend line and clear the 10-period moving average, market will try to wipe out the bears, stop them out, and suck in the bulls before wiping them out. And that's what the market is designed to do. Listen carefully. I don't know if that scenario is going to play out. It really depends. It's technical analysis based on support and resistance levels. It's based on, confirmation and follow-throughs and signals validating things. And right now you got mixed signals. You're starting to do technical damage, but we're rebounding, as we talked about the strong possibility of that happening yesterday with that waterfall sell-off on the 15-minute chart, and you've got your inverted hammer became very oversold going into the jobs report. I'm just telling you, we get above the trend line, we get above the 10-period moving average, still by time. We're starting to see, though, liquidation. We're starting to see distribution. Signals in a program to spot distribution, and I showed you that on Thursday. We're starting to see that. That doesn't mean we still can't go to a higher high to one of the two trend lines I'm showing you. So I'm just telling you, look, if the institutions did run it back up, it would be to stop out the shorts, suck in the longs before lowering the boom on both of them. And that's what these guys do. They get their jollies doing stuff like that to the retail investors, and they are an equal opportunity hoser for both the bulls and the bears alike. I don't know if we get a game like that. We could. I get the CPI data, which again could create a sigh of relief or a lot of volatility. So we'll be watching. Keep that in mind. Again, we're at this resistance. We start clearing this level. Then maybe the S&P tries to see momentum turn up here. We don't see a peak until we reach another extreme. So just something to be thinking about. And again, you move above this area, you're going to be triggering the stops. Just know that. We got a lower high so far. Will this peak right here hold or not? And if so, then you've got this resistance zone with this peak here and these two peaks over here. Clear that, then we're likely going towards 5,300. Talked about this 200 period moving average, and again, we're bouncing off of it. You got to take it out and remain below it. So you get back above the momentum cloud, you get above the momentum line and the momentum, trending cloud there. Kind of hard to see. They're both there, but kind of in that same area. We clear those levels, then again, that resistance zone directly overhead that could be challenged. Now that is short-term momentum here on the 60-minute chart. Parameter really is momentum for the larger swing move. And again, it's still in positive territory with the run-up. If we're going to break down here, you've got to take out the 200 period, and you've got to see parameter go negative. Okay? And a parameter, if you take out the 200 and parameter goes negative, then you're going to get a drop. Now here, we got back above the 200, parameter went positive and remained there. Here it kind of went, we're counter transit over through the 200 period during the decline. But here, stronger uptrend, and we've held above that 200 consistently. You start dropping below it, you start seeing parameter go negative, then you're going to get your reversal. So that's what needs to happen in the 60-minute time frame. We, again, don't have follow through to the breakdown of the rising wedge. We end up getting back up and challenging those highs. Trend lines I showed you earlier in the daily time frame then come into play, the upper boundary of the rising wedge and the upper boundary of the channel. You see all of those trend lines right here, the rising wedge, the lower boundary right here, and again, upper boundary. So we'll just be watching some of these trend lines if we do attempt a further rally. If the bearish engulfing is out, then we'll see what happens. We did get an inside day. The wide range bar followed by the bar inside is actually potential bullish pattern. So now you have an engulfing the previous day's bar, and then you get this inside day. So do we get confirmation to the downside? Follow through here, a confirmation and follow through with the breaking of the blue line there, or does the inside day give us further upside and we get above the blue line, as I mentioned first, and then get back above this trend line? And then we'll be watching these trend lines up in here. But again, see confirmation and a fall through, going to get a reversal. Big institutions run it back up, just to confuse everything and drive everybody bananas, back up and pull the rug out from under the bulls, run it back up and trigger all the stops on the bears. So you got to wonder if we've had a legitimate breakdown. We need to see more signals turn bearish, which I'll be talking about my next update. We need to get here in a fall through, breaking of the blue trend line, and then now with this bar here, we have confirmation. Now we need a follow through, closing below that bar with our rising wedge.